Wait, I thought investment banking and private equity were the same thing. What's up, YouTube? It is your boy Jerome back at it with another video, and today we're going to be talking about the differences between investment banking and private equity. Now, if you're like me, then literally 2 years ago, you had absolutely no idea what a PE firm was. But that's okay, because that's why you're here today. And if this sounds a lot like you and you're just trying to figure out what you want to do as a career or figure out what investment banking is or what private equity is, make sure to smash that like button down below for the YouTube algorithm. It'll really help me out and it'll help out other people like you. So be a good person and smash that like button. Let's start off with a high-level understanding of what each of these two things are. Investment banking is an advisory business. So you advise clients on different transactions. So this could be a merger and acquisition. This could be an IPO or secondary offering. This could even be selling debt on the bond market to raise money that way. Private equity, on the other hand, is an investment business. Their goal is to raise a lot of money from ultra-rich people or sometimes even pension funds or endowments and take all of that money and identify and invest in specific businesses that they think could be successful, hold those businesses over the next, let's call it 5 to 7 years, and then sell off those businesses for a massive return that they split with their investors. Let's think about the word private equity. Private equity. Private equity. Well, from your basic understanding of finance, you should know that equity usually means some sort of ownership in a company. Usually when we talk about this, we talk about stocks on the stock market. Like when you buy a stock, you own equity in that company. Slap private in front of that, and now you have private equity, meaning those companies are just that. They're privately owned companies. They're not publicly traded on any sort of stock market. So these private equity firms are getting equity ownership in privately held companies. Does that make sense? And while investment banking is about churning out deal after deal after deal, private equity is more about holding a company, improving it, making sure we can improve the returns that it can get for its investors, and then selling it at the right time for maximum profits. And for investment banks, they earn money through fees. Typically, for a regular deal, they'll get anywhere between 1% and 2%. Whereas for private equity firms, yes, they also have fees. But in addition to fees, they get to participate in this thing called carry. So when a private equity firm raises all this money from ultra-rich people, they typically charge a 2% management fee. And they're going to always get that 2% management fee. But in addition to that, if they have exceptional returns that are even higher than what was expected or agreed upon, then they get to participate in what's called carry, which is typically about 20%, and whatever excess returns they can provide their investors, the private equity firm actually gets to keep 20% of those excess returns. I know that sounds a little bit confusing, so let's break it down with a small example. Let's say in a given year, an investment bank closes a deal for about $50 million. They charge a 2% fee, so for the year, they make $1 million. Simple. Similarly, in the same year, let's say there's a private equity firm that raises $10 million from their investors. Let's also say that they promised their investors that they would give them back at least $30 million by the end of the year. By the time the end of the year rolls around, they actually end up selling those investments for $50 million. So same deal size as the investment banking example, $50 million and $50 million. How much money did this private equity firm actually earn? Well, okay, so they'll get 2% on the money they raised. So 2% of $10 million is going to be $200,000. Then they promised to return $30 million, but they actually sold all of their investments for $50 million. That means there's an excess of $20 million. Now, the private equity firm is entitled to 20% of the 20 million that's in excess to what was agreed upon. So 20% of 20 million, that's $4 million. So what was their total earnings for the year? They get the $4 million from the carry and the $200,000 from the fees. So it was a total of $4.2 million for the year. And remember, all of that is off of this same 50 million number. 1 million for the investment bank, 4.2 million for the private equity firm. And of course, like all of my examples, this is a super simplified version because a private equity firm would never sell its investments within the same year. That would be super, super rare. Usually they're going to hold on to these for probably closer to 5 to 7 years. But it is a good way to illustrate how the ceiling for private equity is so much higher than the ceiling for investment banking. For example, in 2021, the highest earning investment bank was JP Morgan, who ended up earning $12.8 billion. Whereas the private equity equivalent that earned the most amount of money in 2021, the Blackstone group, ended up earning a little over $20 billion. Which brings me to my next point, which is salaries in both of these careers. Typically at the junior levels of analyst or associate at an investment bank, you can expect to have total compensation, so base salary plus bonus, anywhere between $100,000 to $300,000 per year. Now, early on in your career, this is actually pretty similar in private equity, but where things really start to change is at the VP and MD level. And that's because for VPs and MDs at private equity firms, they're the ones that get to participate in that carry. So being able to participate in that carry gives them exposure to a incredibly high salary ceiling, meaning they have the potential to earn way more money than you could in investment banking, just depending on how well their investments do. Another big difference we got to talk about is the work-life balance. It's pretty much generally accepted that investment bankers have a much worse work-life balance. This is mainly because of the amount of deal flow that comes through an investment bank. A junior banker could oftentimes be staffed on 3, maybe even 4 deals at a time, whereas their private equity counterpart is more than likely just going to be focusing in really, really deep on one portfolio company that they're in charge of. Now, I should be clear, private equity professionals still work a ton of hours when compared to tech firms or regular 9-to-5 jobs. You could expect probably something closer to 65 to 75 hours a week as opposed to the 80 to 100 hour weeks that you would expect from an investment bank. The last thing I want to mention is the exit opportunities available in both of these fields. Typically in investment banking, especially when you're talking about the bulge bracket banks, most people outside of the financial industry know the Goldman Sachs's, JP Morgan's, Morgan Stanley's. So you really have that brand recognition no matter where you want to go after investment banking. For private equity, not a lot of professionals outside of the financial services industry necessarily know about Apollo or KKR or Blackstone or even Carlyle. But I want to be clear, this really only matters if you're going to be leaving finance altogether and, either going back into industry or going to go work for a startup. The other big thing to mention here is that a very, very common exit opportunity out of investment banking is to go into private equity. And mainly that's because a lot of private equity firms don't recruit at the undergraduate or college level at all. They like to recruit from other investment banks because they know that you already have that deal exposure and you've been willing to work the 80 to 100 hour weeks, so you have that drive. I would actually argue that it's easier to go into private equity if you spend 1 to 2 years in investment banking as opposed to trying to recruit into a private equity firm directly from college. Those are basically all of the differences between investment banking and private equity. If you have any other specific questions, make sure to leave them in the comments down below, and I will make sure to answer it to the best of my ability. As always, if you enjoyed the video, make sure to smash that like button down below and subscribe to the channel. I'm your boy Jerome with all things tech and finance, and I'll catch you guys next time. Peace.